Okay, so we will now look at the second type of interest rate futures, also trading here on the CME exchange. And the contract we will look at now are US Treasuries futures, right? So you can see here a bunch of contracts with different maturities. We will focus here on this one, on the US Treasury bond futures, which is like the benchmark, the traditional contract that inspired all these other contracts that you see here. Okay? So the underlying for these Treasury bond futures, we can think of this as an underlying bond with a maturity of 20 years. Okay, it's not exactly like that. We'll get to the details in a second, but it's roughly that, right? So again, this is the original contract. You now have other contracts with shorter maturities, like you have here the 10-year T-note, the 5-year and 2 years, and so on. And actually today, you even have more volume in this 10-year and 5-year than in these old Treasury bond futures. But they all work pretty much in the same way. So we will discuss how this original contract is defined, right? So looking at that contract in more detail, you can, if you open this page, what you can see here is the quotes that exist on the market right now. Okay, so it's February, 17th of February, and you have quotes for 3 contracts, one that expires in March, another in June, and another September, all this year. Okay, so this is very different from the previous contract that we saw, the Euro-dollar futures, where you had, this table was very long, so you had contracts going out until almost 10 years. Okay, so here it's not like that. You only have 3 contracts alive right now with short expirations, but the difference is that each one of these is on a bond that has a very long maturity. So instead of being on a short 3-month rate, this is a contract on a very long bond with 20 years to maturity. So this gives you exposure to very long interest rates. Okay. So let's look at the details. Right. So again, the underlying is a U.S. Treasury bond, okay, with a face value at maturity of $100,000. And now, so more specifically about the maturity, what is really the underlying is not one specific bond. The contract can be fulfilled with a bond whose maturity is between 15 and 25 years. Okay. The contract is quoted in these weird numbers. So if you go back to the CME page, what you see there are these weird prices, which are not decimal numbers. But here in these notes, we will ignore that and just use decimal numbers. Okay. All right. There is a bunch of options that are embedded in this contract in the following sense. So when the contract reaches the delivery month, the contract has physical settlement, meaning that the short side really delivers one of these allowed bonds to the long side. Okay, but the way that this delivery is done is with some conditions that favor the short position, or that give some options to the short position. So there are several options like you see here. We will focus on the first one. Okay, so the idea is that, again, the short position can choose a specific bond as long as it fulfills this range of maturities that I just described, right? So obviously the short position is going to pick the one that is less costly for him to buy, okay? Because he has to buy it in the market to deliver to the other side of the contract. So you will choose the one that costs less money for him to buy. So there will be one bond that we will call the cheapest to deliver, okay? So let's focus on that, okay? If we did nothing, okay, if this was the end of the story, then there would be a problem, because I mean, every trader, every short position would pick exactly the same bond that would be the cheapest to deliver, okay, and that would concentrate a lot of demand on that specific bond, and that might create a series of problems leading to market manipulation, potential market manipulation, and particular potential unraveling of the futures market. Okay, so what the exchange does to prevent that problem is to implement a conversion system. Okay, so the idea is that we are going to come up with a system to try to make all the bonds that are within the maturity range equivalent. Okay, however, this system will not be perfect, and the bonds will not be exactly equivalent. So they will become almost equivalent, but not right, not exactly equivalent. So there will be one that will be slightly less costly to deliver, and still there will be one bond that will be the cheapest to deliver. Okay, so it's a system that solves the problem for the most part, but not fully. Okay, so let's see how that system works. So the exchange determines a conversion factor for each of the delivery bonds. So for each bond that at maturity of the contract has a residual maturity between, again, 15 and 25 years, right? So all these bonds. So uh, note that I at any point in time, I know what will be the residual maturity of all the bonds that I have in the market right now at any future date, right? Because the maturity of each bond is fixed, is known. So this is common information that is objective, right? So what is that conversion factor? The conversion factor is the price that the bond would have if on the first day of the delivery month, the bond was priced to have a yield to maturity of 6%. Okay. So for example, let's compute the conversion factor for two bonds. So one bond, the first one, let's call it A, pays a coupon of 10%. Again, this is a treasury bond, so we already know that these 10% are paid semi-annually, so 5% each 6 months. Okay. And it has a residual maturity of 20 years on the first day of the delivery month. Okay, so again, this information is fixed, is known. It's known since the bond was issued some time ago, and I can always compute the price that the bond will have at some point in the future that I want if I assume a given yield, right? So the conversion factor says, okay, what will be the price of the bond at the first day of the delivery month if the yield is 6%? Okay, well, it's just the present value of the cash flows at that yield of 6%. Okay, again, 6% it's an annual figure. We use semi-annual compounding, so we divide 6 by 3, and that's 3 you see here. Okay, so I compute the present value of future cash flows, and this is the price that the bond would have if the yield was 6%. Okay, it's a high price, right? Because this bond is paying 10%, which is more than 6%. All right. Second example, bond B. Now it's the opposite. It's only paying a coupon of 3% and it has 16 years to maturity. Well, same type of calculations. I know the coupons, I know the coupon dates, I know the maturity. I can just discount those values. Again, using a yield to maturity of 6% per year or 3% every 6 months and compute the price. And the price in this case would just be 69%. Low, it makes sense that it is low because the coupon is 3%, whereas the yield is higher at 6%, right? Okay, so we know this number, this conversion factor for any bond that we want, okay? And in particular, we can make a table of conversion factors for all the bonds that will have the residual maturity within the range that is allowed to be delivered. All right, so what is the bond price in the futures contract? Meaning, what is the price that the short side will get when he delivers the bond? It is defined to be the most recent futures settlement price. Okay, so this is the futures price that we observe on the CME, right? Times the conversion factor for that specific bond that the short side chooses to deliver, plus the accrued interest on that same bond. Okay. So the futures price is common to all bonds. What varies from bond to bond is the conversion factor that we just determined, plus the accrued interest on each bond. Right? So for example, suppose that the futures closes at 98. right? So what would be the invoice price that I would get, or the short would get, for each of these two bonds that we just saw in the previous example? Well, it is just this 98, the futures price, times the conversion factor of each bond. So for example, for bond A, I get this number here, 146, multiply that by 98, and get this um, F times C, right? Then I would have to have the accrued interest, but we are assuming that we are at the beginning of the coupon period, so the accrued interest is 0. Therefore, the invoice price is exactly that amount, right? And likewise, I can do the same for the second bond, for bond B, right? All right. So now what the short side will ask is which one is the cheapest to deliver, right? So what is that? The cheapest to deliver is the one that will minimize the cost of delivering. What is the cost of delivering? Well, it's the cost of buying the bond in the market minus the revenue that the short gets from the other side of the futures contract. Okay. What is the cost of buying the bond in the market? Well, it's just the invoice price in the market. So it's the quoted price in the market plus the accrued interest, right? And what is the revenue that we get from delivering in the futures? Well, it's just this expression that we just defined up here, which is how the futures work. So how much do I get from delivering? I get the futures quote times the conversion factor plus the accrued interest. Okay. I apologize for this notation. This is really sloppy. I should have made this more clear, but um, everything here is specific to the bond. So this is the quoted market price of bond I. This is the accrued interest for that same bond I. This is the conversion factor for that same bond I. This is the accrued interest for that bond. The only thing that is not specific to this bond I is the futures quote. This futures quote is common to all bonds. Okay. Anyway, the accrued interest cancels on both sides, so we get just the difference between the quoted market price and this futures price, all right? And we call that, in this context, the basis of bond I, right? So this is defined in such a way that if the futures, this F, ends at 100%, and all bonds are trading in the market at a yield to maturity of 6%, then this makes all bonds have exactly the same cost of delivery, which would be 0. So in that very specific case, the system would work perfectly. All bonds would be exactly equivalent. But as long as one of these conditions is not true, then there may be some differences between the costs of each bond. Okay. So for example, let's assume that both bonds in the delivery date are trading at the yield to maturity of 6%. So this part of the condition is fulfilled, okay? But as we were assuming back here, the future was closing at 98. So this part of the condition is not verified, right? So there will be a slight difference in the cost of delivering these two bonds. So let's compute exactly what is the cost. So for bond A, the quoted price is what we defined already, which would be the present value of future cash flows at the yield of 6%, which is exactly the conversion factor, okay, that we did before. The invoice price that we get from the futures is this F times C, which we already did here, okay? So this is how much money I can get from delivering this bond in the futures contract. And therefore, the cost of delivery will be the cost of buying it in the market minus the revenue of selling it in the futures. So a cost of 292%. I can do this exactly the same calculations for bond B and find a cost of 139%, right? So the short side of the futures contract, we'll look at these two numbers, which are costs to him, and choose the one that is lower. So in this case, pick bond B, right? So in summary, what would happen at the delivery date of the contract? What the short party would do would be the following: he would go to the market for each contract unit. For each futures contract unit, he would have to purchase $100 of face value of this bond, B, okay, for a total cost of this, which we already computed, so 69% of the $100,000. It would take those bonds and deliver that to the futures, receiving this amount here that we just described, so 68% of those $100,000, okay, meaning that the net cost for the short position would be 1.39% of the $100,000, which would be this per futures contract, okay. And let me stop here.